Hello, everyone. Good morning to those on the West Coast and good afternoon to those on the East Coast. Thank you for joining us today for Business Guide to Taxes, Expiring Tax Incentives. I'm going to quickly go over what we're going to cover today and do some intros. All right, so today we plan to cover introductions. We're going to talk about the expiring tax provisions, as well as the overall tax policy landscape, so everyone has an understanding of what is happening here in Washington, D.C., and then we will end with an update on CARTA's Innovation Coalition efforts around tax policy. And then we have Q&A, and we have plenty of questions that were submitted from the audience. I did want to start by saying that at CARTA, we have quarterly tax webcasts about policy and the issues and updates that we think that customers need to be aware of. But to understand that today is a primer on tax as we head into 2025 tax reform. You're going to hear all the speakers talk about that a lot today. This is just the beginning of a discussion that we hope to have in the year to come about issues to be aware of and to get feedback from everyone, all of you, on what matters to you, what matters to businesses, what matters to investors, so that CARTA and our coalition members kind of know which direction to focus on and how to prioritize what we advocate on. So with that, I will do a quick introduction of myself. My name is Amy Miller, and I'm a Director of Public Policy here at CARTA. I'm based out of Washington, D.C., and my background is that I am a CPA. I used to prepare returns, and now I work in tax policy and advocacy. Specifically, one of the things I'm passionate about is helping businesses understand what tax implications are, but also to advocate and lobby here in D.C. to reduce compliance burdens and tax burdens for the business community. With that, I'm going to turn things over to our speaker, Kevin, so that he can introduce himself.
Hi, thanks, Amy. And thanks, everyone, for joining today's presentation. My name is Kevin Jacobs. I'm a Managing Director, the National Tax Office Practice Leader, and the Restructuring Tax Services Co-Leader of Alvarez & Marsal, which is a consulting firm that regularly advises large multinationals, high net worth companies, as well as portfolio companies and private equity. My role is focusing on policy as well as highly technical topics, and so we look forward to sharing the insights that we have along with Amy and Josh. And I am also based in DC, and my further background is I am a CPA attorney as well as I formerly worked at the IRS. So with that, Josh, do you want to introduce yourself?
Thank you, Kevin, for that intro, and thank you, Amy, and everyone else at CARTA for inviting us. I'm a partner at Pillsbury Winthrop Shaw Pittman, based in the New York office. I also regularly work out of our Miami office as well. My practice is working with clients with respect to tax and non-tax legal matters for generally three groups of clients that are really relevant to today's topic. Those are investment funds, venture capital funds, private equity funds, family offices, and founders. And so really kind of being part of the full life cycle for those three verticals. And like I said, happy to be here, Amy, Kevin.
Thank you both. All right, and with that, I think we're going to start with, the expiring tax provisions. And before we get started, I wanted to share that we know that our audience today is made up of investors, private equity, VC, enterprise businesses, and perhaps CFOs as well. So we'll try our best to kind of share how each of these provisions impact the different areas of business, give a primer of all the areas, and then talk over the landscape, what may be changing, and what are the policy areas to be aware of. Right. Josh?
There you go. And I don't see the screen. Are we sharing that somewhere?
Let me.
The slides.
Reshare. Okay.
Okay, great. So in terms of the individual provisions, we have a provision that has been very valuable to many taxpayers, which is or the provision that is valuable to many taxpayers that are in the investment context is Section 212. The ability to deduct those expenses is coming back in play, which is going to be a huge benefit to taxpayers. There's the sunset provisions that we'll be discussing here today. There are many provisions that were enacted in 2017 that either were entirely new provisions that were added to the code, or certain provisions that were essentially eliminated, like 212. In this case, we kind of, from a taxpayer perspective, want this provision to come back. We're looking forward to that. And certainly that'll be a huge tax efficiency for many investors in the space, whether that be private equity or venture. Unfortunately, as I said, there's a mixed bag of goods coming along with these sunset provisions, because there's going to be some good things that have been implemented that will go away. And we'll get into that in some of the following slides. But, for example, in the AMT exemption, for the last, it's hard to believe, but essentially 7 years, there has essentially been no meaningful alternative minimum tax at play in the tax landscape. And being attentive to what Amy said earlier, we don't want to make an assumption that everyone on this call are tax nerds like myself and Amy and Kevin. So what is the AMT exemption? Well, generally speaking, at a high level, prior to the 2017 Tax Act, a lot of taxpayers were subject to what was essentially an additional tax, where in particular taxpayers who derived a lot of, for example, capital gain, a large portion of their income was attributable to capital gain, were subject to an additional tax. Well, since 2017, that tax has been gone and it's coming back. So, I mentioned 212 deductions and the ability to deduct those costs coming back and that being a good thing. Well, the AMT exemption or the AMT tax in general is coming back with a lot of teeth to it if they're absent congressional action. And I should say, and certainly Amy and Kevin, we will all be talking about this, it's not just that there's sunset provisions that will occur at the end of 2025. Hard to believe that's basically 18 months, 19 months. But this is also happening, obviously, with an election less than 6 months away. So, it's almost like two storms colliding. You have what will naturally occur as written into the statutes, the laws that were enacted in 2017, plus you have this unknown of the election. So as Amy presented the topic, there's these expiring provisions, but there's also just an uncertainty of the political landscape and what large portions of the tax code will look like in practice and in form. So, kind of continuing on that, in the individual context, again, whether we're talking about individual founders who may be on this call, or hedge fund managers and everyone in between, there has been a dramatically different landscape for itemized deductions. And by that, I mean, there have been no itemized deductions since 2017. So personal tax planning or personal tax reporting has been drastically different over the last 6.5 years compared to beforehand. And those deductions, again, this is a good thing. It's a theme here about the mixed bag of goods with these sunset provisions. Those deductions are coming back into play post 2025, which is a good thing. And then finally, of course, for those of us, myself included, who live in a high tax jurisdiction up in the Northeast, we are happy to see the SALT limitation go away and the ability to deduct dollar for dollar. Oftentimes what feel grotesque state income taxes that we pay in places like New York and Connecticut will be deductible or creditable for federal income tax purposes. And so, it's a mixed bag, and I think we can probably turn to the next slide.
I was going to add on miscellaneous itemized for an example of, if you're wondering what some of those deductions were that went away and could be coming back at the end of 2025. Miscellaneous itemized deductions would include like your home office deduction that hasn't been here for 10 years that would return, management investment costs, and tax preparation fees. So a lot of business related costs that previously were deductible have not been for 10 years and may come back or will be coming back after 2025. Kevin,
I think the other thing just to be mindful is, right, we're talking about these are upcoming changes that are impacting federal income tax. we have to be mindful, and obviously we can have many hours of discussion with regards to state income taxes and the implications. The only thing I want to note for everyone is there's a key term with regards to state income tax, which is what is conformity. There are many different states that have different rules as to what federal income tax rules actually apply with regards to states. Some have what's called rolling conformity, which means whatever change that we're talking about in federal will also be adopted on the state side. Other states actually have fixed date conformity. And so if, for example, they said, oh, we want to conform as of the January 1st, 2024 Internal Revenue Code, all of these changes that we're talking about actually aren't going to flow through on the individual side for state income tax purposes unless they update their conformity date. So just to add another layer of complexity that people need to be mindful of these are great changes for federal, but it's not necessarily going to flush through and impact your state. So just be mindful of your situation, especially when we start thinking of pass-through and what happens in your allocations of income to all the various states and your filings. This is just another level of complexity that people have to think about.